You're listening to The Voluntary Life, where you can hear ideas for finding freedom in an unfree world. Visit thevoluntarylife.com to connect with the show and hear all past episodes. Here's your host, Jake.
Hi, it's Jake here. Welcome to The Voluntary Life. This is another episode about financial freedom, and I'm very pleased to have a special guest on the show. It's Todd Tressider, who runs financialmentor.com. Hi, Todd.
Thanks for having me, Jake.
Great to have you on. I'm really keen to talk to you about the work that you do and some of your ideas about personal finance and financial freedom. But perhaps it'd be useful just to start off to give my listeners a bit of an overview of your background and how you got involved in these topics.
Well, my original start into it was in the hedge fund business, and my passion was financial freedom. And I just had this insight. I said, well, if you're going to be financially independent, you have to know how to invest. And so why not make my job learning how to become a great investor? And what better place to do that than in the hedge fund business, which is kind of the rocket science of investing. And so that was my first career out of college. And that's where I built my wealth. And that's where I learned how to invest. And so once I did that, I kind of got to a point where, if I spent the rest of my career there, I hit about age 35, I was quote unquote financially independent. That's kind of an interesting conversation itself or definition itself.
Right.
Because I made some mistakes on that one. But anyway, I thought of myself as financially independent. And then I just was at a point where I didn't want my whole career in my tombstone to read he was good at making his rich clients a little bit richer. And I knew that if I continued on my current career path, that the rest of my life I had already learned how to, so the rest of my career was going to amount to figuring out how to make my, adding 1 or 2 percentage points to my rich client's bottom line. And I was just like, that's just not a real satisfying way to spend your life. So that's when I branched out. And then I got this kind of weird bug up my rear that I thought that I could actually help normal people achieve extraordinary financial results. And that's where Financial Mentor came in, as it was just kind of this question. I was getting a lot of people asking me, like, how'd you do it? Because it's unusual for a guy I'd just gotten married, had little kids, and I was financially independent. It's quite unusual. And so I had a lot of people asking me financial tips and financial advice, and they weren't even asking the right questions. They were coming from the totally wrong place. They all wanted hot stock tips, and they wanted all this crazy stuff. And so one time, and I just really didn't even answer them. I was just kind of blow it off because I just didn't want to go into the topic and dive into all these wild conversations that people didn't want to hear. And finally, my wife challenged me one day. She just goes, Todd, you got all this knowledge. You spent a decade learning this stuff, a decade of your life learning this stuff. Why don't you just figure out how to communicate it? Why don't you do something with it? And that was kind of the challenge. And I said, well, maybe I'll try. So I hung my hat as a financial coach for a while, and I coached a bunch of one-on-one clients, and I fumbled with it and made a lot of mistakes, did a few things right, and just kind of fumbled forward. And eventually I actually worked out a system that would help people. And that's where Financial Mentor is.
Fantastic. Well, that's, you mentioned financial independence in there, and you mentioned that you thought it was a bit of a quite a topic because it depends on how you look at it. And I think it would be really helpful to start off, before we get into the detail, just talking about what you see financial freedom being about, how you define financial freedom and financial independence, and how you see that as being different to maybe what people might get in mainstream media ideas about what it means to be financially free.
Well, a lot of people run around, and I did it too, with the $1 million myth. You get $1 million and you're supposed to be financially independent, or £1 million or whatever currency you're in.
Yeah.
And you're supposed to be financially independent. It's this like magical million number. And I subscribe to that too. And it's not true. Financial freedom is cash flow exceeding expenses. So it's a real simple definition. Your revenue from your investments, passive business revenue, real estate, whatever it is, exceeds your expenses. So that's my definition of financial freedom. And one of the mistakes I made was I claimed financial freedom too early. I thought that I was financially independent. I was as a single male or even as a married male, but I wasn't as a family of four. Right. And so I had made it a little thin and I'd made some mistakes. And again, it's because I just didn't forward look at what would happen to my expenses from raising a family of four, So we all learn and we all make mistakes, me included, So I had done it from one perspective and then expanded my expenses in a way I never even imagined would occur by having a family. So,
right.
No regrets. I mean, it's cool. I love it and I wouldn't change a thing, but, you learn your lessons.
Right, right. Well, I think that's a great definition, and I think it also really brings out the point that your overall level of income, to a certain degree, is actually a bit misleading when looking at the question of financial freedom, because it really depends on what the relationship is between your income and expenses, and whether or not you have enough passive income to keep yourself going. And
this is extreme, Jake. I mean, what you're saying is so true. You have no idea. I've had a client who had $30 million who didn't view himself as financially free, and I know personally of people who live on $1,000 a month,
wow,
and consider themselves financially independent. So the gamut of how you define financial independence, that's why the formula is passive revenue exceeds expenses, because it works regardless of your value system. The breadth of the value system is a function of the breadth of the dollar amount involved to be financially independent is a function of your values and how you express that in your spending levels.
Absolutely. So you can be an extremely frugal, financially free person, or you can be someone on a very high income who is so locked in to ongoing subscription payments and so forth that you have very little freedom.
Yeah, absolutely.
And that, I guess, brings me on to a question that I have for you, because you've obviously coached a lot of people and you've had your own experience of building yourself up as self-made, financially free person. And for a lot of the people who listen to my show who may be starting out on their entrepreneurial ventures and fairly early on, I wonder if you can provide a bit of an overview of where you see the real, sort of the most common pitfalls or problems that people get into with their move towards trying to be more financially free.
Well, the first one is most people have no plan.
Right.
So they don't really have a realistic plan of how to even achieve it. It's just sort of a dream. There's a great quote out there, a goal without a plan is just a dream.
Right.
So you can have the goal of financial freedom, but if you haven't really worked out a plan with, step-by-step actions to get there, then it's not anything. It's not going to happen. And so the first step is having a plan. And the second step is the second pothole or, obstacle that people generally don't clear is the plan has to be based on proven principles that actually work. So for example, there's a couple principles that have to be built in your plan. One is leverage. Nobody achieves financial independence without some form of leverage, because otherwise you're just trading time for money, and typically your spending will track whatever your growth of income is so that you'll fairly perpetually be locked in. So you need some form of leverage. And then the other one that statistically really shows up a lot is tax advantages. So that's why business and real estate are typically, entrepreneurship and business or real estate are, from a statistical point, the two paths and the two asset classes that lead to financial independence most frequently.
Right. Now, I wonder if you could go into a little bit more detail about leverage, because when people hear leverage, they may think, well, okay, were you talking about using loans to do sort of invest in the next best big thing and so forth? So maybe you could talk about what you see leverage as being, or how you'd like to explain that.
Well, there's all kinds of forms of leverage. And what I do is I consciously pick my leverages at different points in the economic cycle. So, for example, I use financial leverage in my hedge fund career, and I was leveraging basically my clients' assets as an income stream through the hedge fund business to build my own wealth. And so there was financial leverage, and then there was different forms of leverage within the business itself, but mainly it was financial leverage. And that is risky. That one, your listeners would be correct in assessing that that's a risky approach, because financial leverage is one of those leverages that cuts both ways. So it makes the good times really good. It makes the bad times horrible, because it does cut both ways and you can get really burned. However, I did leave the hedge fund business and start on other paths. So then I built a whole real estate portfolio from kind of 1998 all the way up to about 2003. I had a whole strategy for apartment buildings. So I was using financial leverage there as well. But I had some other forms of leverage in terms of knowledge leverage. I had specialty knowledge in the strategies I was applying. I was leveraging some contacts, resources, network. And that one was fine. And then I reached a point where I was very uncomfortable having any financial leverage kind of around 2005. I could see the bubble coming. There was some certain telltale symptoms. I was really getting uncomfortable, and I started unwinding my real estate portfolio. And by the end of 2006, I had sold everything except the house I live in. I cashed out all my real estate about 2006 as a conscious move to remove financial leverage. I was really uncomfortable with the credit bubble that was going on at the time. And there was some really telltale symptoms that it had reached a breaking point. And so I consciously chose to change my leverage. And so now I'm choosing technology leverage. I'm choosing knowledge leverage. I'm leveraging all these different resources on the internet. It's a whole different approach to leverage, and it only cuts one way. It doesn't cut both ways, so it's not risky. The only thing I'm risking is my time. I'm not risking capital, which was totally intentional. See, I'm at a point now in my life, I don't have to risk capital.
Yeah.
And so I consider financial leverage extremely dangerous in the current environment. And I felt that way since about 2005, and I still feel that way today. And so I've completely restructured what I do with my time and how I approach business by pursuing leverages that don't cut both ways. So, I don't know, does that explain?
I think so. And just applying that, so just to sort of paraphrase it and look at how we might apply that for listeners in terms of their own experience, what I get from what you're saying is that, yeah, you can use financial leverage to borrow, to invest, and if you make a good investment, it's gonna really increase your returns. But of course, if you make losses, then you have serious debts to repay too. So it really multiplies the losses too, and so it's dangerous. And what you're saying is, but that sort of general principle you look to apply, not in terms of borrowing money to invest in stuff, but in terms of using your specific skills in an area to create leverage by basically having unique skills or knowledge and so forth. So how would you, how
about this? How
Sure,
about this, Jake? Let's go down to tangible examples, okay?
Yeah.
Just let's take it down so people can really get it. So real estate is a great example of financial leverage, okay? So let's say I buy an apartment building and I use 20% down. So I'm 5-to-1 leveraged, right?
Yeah.
Or 4-to-1, depending on how you define the leverage. Because it could be 4 parts borrowed for 1 part equity.
Payment.
Yeah. So anyway, let's call it 4-to-1 leverage. So let's just use $100,000 to make this really simple. Okay. So if I'm into it for $20,000 and the building increases in value by 20%, I've doubled my money. Right. And if the building goes down by 20%, I've lost 100% of my investment.
Yeah.
So it's leverage. Even though it's only moved by 20%, it's highly leveraged, okay?
Yes.
So now let's flip it around with my coaching business as an example, okay? To show a completely different form of leverage. In coaching, when I'm doing one-on-one coaching with a single client, so personal one-on-one coaching, there's no leverage involved in that. I'm reaching one person for the time I'm spending with that one person.
Yeah.
Now let's compare it to this podcast. I have no idea how many listeners you are, but let's assume there's 1,000 listeners just to grab an easy number.
Yes.
Okay. So I speak one time with Jake and I reach 1,000 people.
Yeah.
With the message. Or to use another example in the coaching, let's say that rather than do a one-on-one coaching, I do a group coaching program and I build it out as a system. So, and this is what's going to happen. I'm building an advanced investing coaching program coming up either later this year or early next year. And so rather than me teaching my one-on-one clients, like I've been doing this strategy, which is where I worked it out, right? Yes. I'm going to teach it in a large format in a membership site. And so let's say 100 people sign up for it. It's going to take me a little bit more time to do it rather than one-on-one. Let's say it takes me twice as much effort to build the membership site as it does to teach it one-on-one. But I'm reaching 100 people and I'm recording everything. So now I've got a whole business system on top of that. So that's an example of leverage where you're reaching more people. And for the consumer, it's great.
Yes.
So more people for the same effort. For the consumer, it's great because of the leverage, it can be a great business model at a lower price point.
Yeah.
So the consumer gets a better value as well because I can sell it for less and still make a viable business out of it.
Absolutely. Makes perfect sense. So the question, I guess, for somebody listening to thinking about, okay, well, how can I apply this, is what kind of skills and expertise have they got that they can turn from being something that they have to work specific hours again and again and again to make that revenue, to being something that they can have leverage where they, record their knowledge into a book or a podcast or some other product of some kind that they can then sell to a much greater audience and therefore gain a lot more opportunity that way. Is that sort of the way to think about it?
Yeah. You've got to think about how you can multiply your efforts, how you can do something one time and it can reach, get 1,000 times the results. So here's another example. A really common issue I deal with clients is how much money do I need to retire?
Yeah.
I run into that with virtually every client since they're all in pursuit of financial freedom. And so I just kept running into it, and the information out there is totally wrong. I mean, the way it's commonly taught is not valid. And so after a while, I got down a system, and so I wrote a book. So I've got a book on Amazon, How Much Money Do I Need to Retire? And last time I checked, it was actually #1 in the retirement planning section in Amazon.
Right.
I just saw it yesterday. I was like, oh, look at that. It's the top book in Amazon for the keyword retirement planning. I was really surprised, beating out all those New York publishers and everything. So that's an example of leverage. I wrote that book. It took me a lot of work. To produce a really good book is a surprising amount of work.
Yeah.
Writing it is only maybe 1/3 of the work. I wrote it and I thought I was done and I was just getting warmed up. But anyway, so it took a lot of work to get it done. But that book is sitting out there and it's selling, I don't know, like 400 or more copies a month. So, I'm building a relationship with 400 and some odd people a month, really helping a lot of people at an amazingly low price point. I mean, there's an amazing amount of knowledge in that book for all of $3 or $5, depending on what format you buy it in, if you buy it in an ebook or a hard copy or whatever.
Yeah.
I mean, it's almost free. And yet this knowledge is getting spread out. I'm building a relationship with people, and it's a great passive revenue stream. And so I sat down for a period of time, worked hard, got it done, and now it just multiplies.
Fantastic. Yeah, I think that's a really, really great example. So you mentioned, in terms of the sort of 3 key things that you were talking about, you mentioned that one of the key problems people have is not having a plan to achieve financial freedom. And you mentioned the need to find some way to get leverage so that you can multiply your efforts.
Well, actually, that one came in under the idea that you have to have the plan based on the right principles.
Right. Okay. Yes.
Right. So the plan has to be based on the correct principles in order to work. I mean, a lot of people will sit there and they'll work a plan and, like let's say your plan is a ditch digging business.
Yeah.
And you've got this amazing ditch digging business and you start bringing in your host of employees, but will that ditch digging business ever really build wealth? Probably not. So you've got to look at is there a realistic way by which this is going to work?
Right.
It's
right.
So there's no point in climbing the ladder to success if it's leaning against the wrong wall.
Right.
And then the other thing too you want to look at is, when this thing does work, am I even going to want it? Like a lot of people build these things and they get there and they go, wait a minute, I don't even like this. What did I do?
Do you mean in terms of the business itself, like whether or not they're building something that they just don't have any interest in, or do you mean in terms of working towards financial freedom?
Yeah, it can be the business. It can be the portfolio. Like as an example, I had a client come to me and she had a whole host of single family homes. She had a bunch of single family homes as her portfolio. And she had bought herself a half-time job.
Right.
And didn't realize that real estate there's a continuum between passive and active for every investment in business.
Yeah.
And you've got to decide where your values lie and where you want to end up with this. So, for example, I'm really into the passive side of stuff because I value freedom. That's why I did all this. And so I love my book revenue, My coaching revenue I love because I love connecting with people and I love, figuring all this stuff out with people. It's revenue producing market research, if you will.
Yeah.
So I love it in that sense, but from a business model, it's horrible. It'll never produce wealth.
Right.
So you got to understand where it's going to take you when it finally works. If I have 15 bestsellers on Amazon, I've got this amazing business with an amazing revenue stream. And it's very stable. If I have 20 clients, I've got a job.
Yes. Yeah.
So you got to decide what you want and make sure that business is going in the right direction. Same thing with portfolio. You've got to decide what the portfolio will be doing at the end, and is that really what you want?
Right, absolutely. I did want to ask you about real estate because you mentioned it as being, as paths to financial freedom. You mentioned entrepreneurship and real estate as well. And real estate's one of those things that also, as you say, people think of it as being passive, but to my mind, it does just look like that client you'd mentioned who had all those single-family homes that she'd bought into her portfolio and was having to kind of manage. It does just look like another business. And I think a lot of people get into real estate imagining, at least in this country, imagining that if they buy a property to rent, then they will, it'll be a great opportunity for them to get more financial freedom. But there's actually quite a lot of competition of other people trying to do that as well. And I guess I wanted to ask you, what makes real estate special to you in your mind, that it's not just another entrepreneurial activity? Why is it something that you think should be considered, I guess, by anybody interested in financial freedom as opposed to any other particular entrepreneurial activity?
Well, real estate is half business, half investing. It's a hybrid. So if you're going to run a real estate portfolio correctly, you're going to run it as a business and run it as a professional in the industry. So with that said, you acquire enough of them and you can have some employees underneath you who run it for you, and then now you've gone back to passive status. So again, it's how you put it together. The beautiful thing about real estate is that the income does tend to grow with inflation, and the asset does tend to grow in value with inflation. So when you get it to the point that it's producing positive cash flow, and I wouldn't recommend acquiring real estate that doesn't do that, to the extent your portfolio produces positive cash flow, it's an income stream you can never outlive as long as you maintain it. And that it will index with inflation. And there's just not a lot of investments you can say that about. And so that's a very redeeming feature of real estate. But with that said, you've got to understand what you're getting into. So, for example, my plan was to acquire large apartment complexes. I was going to acquire one a year and then, wrap my hands around it in a year, get it operating systematically, and then go on to the next one as I was hiring professional management. And I thought that was going to work. It didn't. I was wrong. I had the plan structured wrong. I learned something about being an out-of-town owner, and it was way more work than I ever imagined. And it was partially because of the type of real estate I was buying, and it was also the fact that I was an out-of-town owner. The combination was just unmanageable. And so, again, I unwound it all because I realized I had some fundamental flaws in the principles of my plan. I'd blown it. So I still made money on it. I still came out fine because I got out before the bubble burst. But again, we all make mistakes.
Yeah. And so looking back on all of that and with all of the clients that you've coached and stuff, for somebody who's putting their plan together, do you have any overall view about how important you think real estate should be in terms of someone's plan? Is it one of those things where you're saying that, if you specifically have some knowledge of the real estate market, then maybe this is an opportunity? Or are you saying that, do you think that everyone should really look to include real estate?
No, I want to be clear. I don't have a bias towards any. So first of all, let's clarify. There's 3 asset classes that are going to be part of your wealth plan, right? So you've got business or entrepreneurship, you've got real estate, and you've got paper assets. So typically business entrepreneurship and real estate is where wealth is built. Paper assets is where wealth gets parked to grow at a rate in excess of inflation, to grow its purchasing power.
Yes.
Most people do not typically build wealth in paper assets. Typically, your wealth is built elsewhere and then parked in paper assets. And so I do not have a bias towards real estate at all. Zero. There's no right, wrong here. It's whatever works for the client. Some people just are really savvy at business, and they can build their wealth in business. They never even need to touch real estate, although typically they will own the real estate the business is located in. That typically is kind of a financial no-brainer. But again, they're not really pursuing real estate as their wealth plan. They're just being efficient with how they translate their wealth. So it just depends. I have other clients who are absolutely passionate about real estate, and they have a competitive advantage in real estate. So, for example, I had a coaching client pair who the wife worked in the local real estate market as a broker, and the husband had a passion for investment real estate. Well, the wife was right in the middle of deal flow. She could funnel great deals straight to him. So they had a competitive advantage. They knew the market really well, and they were doing great with their real estate. That was an example of where that worked for them. Other people can't stand owning real estate.
Right,
so
right.
I don't have any bias toward it at all. I don't think there's a right wrong. I think it's what works for you. And that's, again, part of the plan is it has to match your skills, your values, your abilities. That's one of the things with problems with so many of the gurus out there is they run around and they say, you got to do X. X is the solution. And X is not the solution. X is going to be the solution for a small percentage of the population, and the rest of the population is going to want to do A through Z excluding X,
Yeah, absolutely, yeah. That makes a lot of sense.
Yeah, there's not one right, wrong way to do it. You've got to find the way that's going to work for you. That's the key. Because you're unique, you're bringing a unique set of skills, values, interests, and abilities to the equation, and you've got to develop a plan that leverages those and harnesses them.
Although I do see what you're saying about it being unrealistic to expect paper assets to be the basis of your wealth. That's more like where you park things, and that entrepreneurship or real estate are really the opportunities, because that's where you can find some real sort of multiplier effects to your own efforts. And so that seems to be one of those principles that you're talking about.
Yeah, there's mathematical limits to the growth of a paper asset portfolio, and that's again, well-documented research. I'm not stating anything that's not new here, or that is new here, I should say. And so really, when you think about a wealth plan, it has three components. You've got the wealth creation component. You've got the wealth translation, how you get it over from where it's being earned or created over into your personal portfolio. So wealth translation. And then you've got the investment growth. So once you've got it over your personal portfolio, how do you grow it at a rate in excess of inflation? So that's the investment strategy side. So you got three components to any wealth plan. And so, again, typically you're going to see either a high-paying job, real estate, or business entrepreneurship over on the wealth creation side. And then that's going to come into budgeting and how much do you, tax strategies, different things on the wealth translation side about how do you efficiently translate that wealth that you're creating over there into the personal portfolio over on the other side of the equation.
Yeah.
And then once it gets over the personal portfolio, then the issue is how do I grow it in excess of inflation? How do I grow my real purchasing power?
Yeah, absolutely. Now, I want to be mindful of your time, but there's a couple of questions.
Well, actually, there's one more thing I want to say on that.
Oh, go for it.
You and I just went through that wealth plan thing, but most people I talk to, they don't get that. Most people I talk to think that they're just thinking in terms of investment strategy. When they think in terms of wealth plan, it's all about investment strategy. I think that's a bias that comes from the brokerage industry where, you go to a broker and you are a financial planner and you get your financial plan.
Right.
And really all it is their prescription for investing.
Yeah.
They say, give us your money and we're going to do this with it. And at some point you're going to have this. And so people think that's like a wealth plan. They've got it all confused in their head. That's not a wealth plan. That's an investment plan for wealth you created somewhere else.
Right. Effectively, that's a parking your money plan, not an actually generating it.
Yeah, they're saying, hey, you dude that went out and created all this wealth, go park it with me so I can suck management fees off of you.
Right. Absolutely.
Yeah, So anyway, I just wanted to draw that distinction because a lot of people don't really get the gem of what I just shared there. Again, it's a wealth plan is very different from an investment plan.
I think that makes a ton of sense, and I do know that you have written a couple of books and articles about things to be aware of about the sort of investment professional industry and things that you need to be aware of before you approach investment advice, basically. And what I get from what you're saying is that key distinction that if you approach investment advisors thinking that you're going to hand over your money and they're going to make you rich, then that's where a lot of people have really just lost a lot in management fee and also in active portfolios as well. I wonder if you have anything to say about sort of your overall view of things that people need to be cautious or aware of when they're trying to develop their own wealth plan, when they're also looking for investment, sort of where to invest their money. What is your view of kind of the industry and what you need to be aware of?
Well, first of all, I don't want to turn this into a call that bashes the industry. There's some really good people out there trying their level best to help people. So it's not just this den of thieves, and it doesn't serve anyone to run around and put the industry down. Now, with that said, you have to also have your eyes wide open and recognize how the industry works and what their incentives are. So, for example, the financial planning business or brokerage business, and yes, there are differences, is really an asset gathering business. So it's driven by a sales model. It is not driven by an investment advice model. That's just the product that's delivered. No different than a used car salesman selling a used car. These guys sell used stocks and bonds. And I use that analogy intentionally to put a framework around what's going on here. They're in the sales business. Their product is investments, and they sell them. Okay? And it's your money that they make money off of, both through management fees, through back-end fees, such as 12B1. There's all kinds of hidden fees that you don't see. There's all kinds of different sales incentives you never see that were paid to the sales broker as to why they were pitching, and they sounded like it was the greatest thing when in fact it was just that they had a huge commission incentive. That stuff happens every day. This is not, and again, there's also some really honest people trying their best, but let's get the context for what's going on here. A lot of these really honest people trying their best to help friends and family who they brought into their brokerage business or their financial planning business only know what they've been taught. So they might just be a little bit naive. They might actually believe what they were taught as being the truth, when in fact that's just the gospel from the company they work for that serves the company for their sales representatives. I mean, there's layers to this equation. So again, I want to be respectful. I want to point out there's some really good people trying to help people. This is not all bad. However, understand that it's a sales business. There's all kinds of financial incentives behind the scenes driving recommendations and advice. There's numerous lawsuits, proving this out, where people have just gone too far off the deep end with how they rip people off. And, just understand, nobody's going to care about your money as much as you do. You are the only person who does not have a conflict of interest on your money. Everybody else, including me and you, Jake, have a conflict of interest with the listener's money.
Right. Absolutely. I just want to come back to tax advantages, because it is another aspect that you mentioned that's important when we were initially talking about developing a wealth plan and looking at some of the key principles involved and looking at some of the sort of major barriers and obstacles. And for people who are starting out in their entrepreneurial career and looking to build their own wealth plan and looking to get more financial freedom, what would you think are the sort of key issues that you wanted to point out with regard to tax?
Well, first of all, the first key issue is never, ever do anything illegal. Okay? Ever. It's not worth it. How can you be pursuing freedom when you're exposing yourself to potential jail?
Absolutely.
So, you just never, ever do anything illegal, just straight up. Okay? And so with that said, you want to take every deduction you're legally entitled to and can support. Because if for some reason the government decides that that's not a legitimate deduction, the worst you will lose, because it was supportable and legitimate, the worst you will lose if they deny it is the value of the deduction, which is the same thing as if you had never taken it in the first place.
Yes.
So as long as you're being completely legal, completely legitimate, following the law, and just taking the deductions you're entitled to, take those deductions. Don't be deterred by these concerns for red flags, as some people call them, to your return or whatever. If you're legally entitled to it, it's within the scope of the law, then you take it. Now, with that said, there's the government has decided in their infinite wisdom, which I say with quotation marks around it, the government has decided that they want to incentivize certain behavior. And so they offer tax advantages to those behaviors in order to encourage activity there. And so that's what you want to pay attention to. You're responding to government incentive. And so that's where, business entrepreneurship as an example, a tremendous amount of expenses are deductible legitimately through a business as an entrepreneur. And so that's just taking advantage. The government wants to incentivize people to form businesses, and that's how they do it. Absolutely legal, perfectly legitimate. Same thing with real estate. The depreciation deduction is phenomenal. I mean, let's say you're depreciating a building over a 30-year time period. You tell me, how many buildings do you know that are 100 years old? There's tons of them. Buildings don't really depreciate if you maintain them. It's an interesting thing. They don't just kind of vanish. They require maintenance over time, but a building doesn't vanish after 30 years depreciation. But after 30 years depreciation, you've harnessed a bunch of cash flow out of that building because that's protected from a tax standpoint. So there's all kinds of tax advantages built into the code by design, by the government, because they want to incentivize behavior. And so it behooves you to learn that. And it puts money in your pocket every year when you understand the tax law and you respond to it and you create smart strategy based on it.
Awesome. I think that's great advice. Well, I think there's a lot that we've spoken about that for people to think about. And I know it can be kind of difficult to do this, but I wonder if we can pull out from the things that you're saying some initial steps for people really just starting out on thinking about developing that wealth plan that you talked about early on in their entrepreneurial careers. What do you think? Just because if they're feeling a bit overwhelmed with all of the things that we talked about, what are some really important first steps that people need to look at in order to get themselves on the right path?
Well, I'll give a self-serving pitch, which is, I don't even advertise it on my site, but I have an autoresponder educational campaign that comes out. It's called 52 Weeks to Financial Freedom. I've only got it about half written right now as of this presentation. But the first part is all about building a wealth plan.
Right.
And they get it totally for free. I don't make a nickel off it. And so when people sign up for my newsletter, they get the free ebook, which you see right there on the site, which provides some educational insights. But then they get this 52-week educational program, which I don't even advertise because I haven't finished writing it yet, but it's already being delivered. And the first part of that is all about how to build your wealth plan. So that's a self-serving answer. Another answer is just to begin taking action and take small action. So I can at least provide that answer in a soundbite. You want to develop the habit of working towards wealth. And, one of my favorite quotes is, your health, wealth, and happiness are all a function of your habits.
Right.
And so this is not that complicated of stuff. If you work every day towards building your wealth, eventually you'll get there. And so just start taking action every day. Okay. An intelligent next step. Ask yourself, what's my next step in my wealth plan? It could be as simple as sign up for Todd's newsletter. It could be read something on Jake's site. I don't know what it is, but each and every day, take a next step. What's the logical next step in building wealth? And just keep taking those steps and build the pattern. And then add more steps. Try to dedicate a little more time to it. If you want to know how long it's going to take you to become wealthy, it's a simple thing. You look at how much of your resources you dedicate to the project. So it's how much time and how much money you spend on your wealth will determine how long it will take you to get there. And so just start simple, get the habit, and then start adding to it and multiplying it.
That's awesome. I think there's a lot of really great content, and I really appreciate you providing those ideas. For people who would like to find out more about your work and other things, best to go to your website. Is it financialmentor.com? Is that the best place for them to find you?
Yeah, it's the only place. It's
right.
Financial Mentor, all one word, MENTOR, financialmentor.com.
Perfect. And is there anything that we should look out for coming in the future for you? Or, are you intending to continue with Financial Mentor? Do you have any interesting new plans or developments?
Yeah, one of the things I'm going to be developing here in the near future is, again, increasing leverage, walking my talk. I've been doing one-on-one coaching. I'm probably going to stop accepting clients at some point in the near future here, and I'm shifting out towards the group coaching model and membership site model. And so the first two membership sites to go up are going to be how to develop your wealth plan and advanced investment strategy. And so, it's the advanced investment strategy is literally being driven by a former client that I taught this stuff to. And it was so life-changing for him that he's literally behind me building it out, saying, dude, you got to get this into more people's hands. This is crazy. And so he's driving me on it, and we're going to build out. It's how you go from a beginner investor to advanced all in about 6 months.
Cool. Great. Well, thank you so much, Todd. It's been a real pleasure having you on the show.
All right. Thanks a lot, Jake. Enjoyed talking with you.
Thank you for listening to The Voluntary Life. If you have feedback about the show, please email jake@thevoluntarylife.com. If you enjoyed this program, please share the podcast with your friends or click the donate button on thevoluntarylife.com.